So first we will try to begin our discussion with the chapter Introduction to the Audit. So we are going to start our marathon with the chapter Introduction to Audit. So as you could see in the material, we have an index here. So as per our material, there will be a total of 15 chapters. So as per my material, which I told you to download from the app, in that material, you will be able to find a total of 15 chapters. See, when it comes to segregation of the chapters, it's going to be a little bit different when you compare with the ICA study material. The chapter segregation is going to be different. See, the overall the content is there in my material, which has been exclusively taken from ICA study material only. But the only thing whatever I have done is I have changed the chapter arrangement. I have arranged the chapters in a proper sequence which will make sense in understanding the concept. So if you follow the chapter arrangement which was given in the study material, so things go out of place. Some chapters are required to be discussed earlier, some chapters are required to be discussed later. So in accordance with the concept, so what I have done is I have did the rearrangement. Sometimes I have clubbed two chapters together. In some cases, I have taken out a part of the chapter and given it as a separate chapter. So at respective places, whenever we take up each and every chapter for discussion, I will let you know. So where you will be able to find the content in this chapter in the study material. So first, we are going to start our discussion with the chapter called Introduction to the Auditing. See, before we go into the concepts of the auditing, first we should understand what is the basic term, what is the meaning of the term audit. So in this paper number 5, the chapter title, so the subject title itself is what? Auditing and ethics. So basically, mostly we are going to talk about auditing. We are going to talk about auditing majorly in this particular chapter. So before we talk about the concepts of the auditing, first it becomes necessary for us to understand what is the meaning of the audit. So in this chapter, Introduction to Audit, we are going to basically understand what is the meaning of the audit, what are the basic terminology used in the audit. See, once we become familiar with this chapter, if we become familiar with the chapter, then only the further discussion will start making sense. So if we don't get a proper understanding of the chapter Introduction to Audit, then even though we discuss the remaining chapters, that will not make that much sense. So to have a better understanding of the overall concept, the most important thing is first we have to get used to the terminology which is used in the auditing subject. What is the meaning of the term audit? So all these things, if we become familiar, then only the remaining discussion is going to make a complete sense. So without any delay further, let me try to explain to you what exactly is the meaning of the term audit. See, we all know for all the things there will be certain textbook definitions will be there. Even for the term audit also, there is one literal textbook definition has been given. There is one literal textbook definition has been given even for the term audit. So let us try to understand what exactly is that textbook definition which is given to the term audit. So if we have a look at the definition audit, it says that an audit is independent examination of financial information of an entity, whether or not profit oriented or whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. So this is how basically the term audit has been defined. So this is what the textbook definition is. But if we read the entire definition in all at one go, we will not be able to make the complete sense of the definition. So what we will try to do is this definition we will try to understand in different parts. First of all, we will try to understand what are the key terms which are used in this definition audit. So once we understand the meaning of the key terms which are used in this definition, then automatically the definition of the audit also becomes very much clear. So what is the definition of audit, sir? Once again, I will repeat it, then we will focus on the key terms. So they say something like this: an audit is an independent examination of financial information of an entity, whether profit oriented or not, irrespective of its size or legal form, when such an examination is conducted with a view to express an opinion thereon. Guys, one of the most important skill which you all must possess is the way how you have to read the sentences, the way you have to read the paragraphs, where to take a pause, where to interpret. So these kind of things you have to learn it. Why? Because the way you read the paragraph, the way you read the sentence, it is going to make a bigger impact on your understanding also. So when you find any lengthy paragraph, don't read that entire paragraph in a single stretch without giving pauses, then you will not be able to understand it. So if you find any lengthy sentence or lengthy paragraph, try to give pauses at appropriate places, interpret that part, then mix it with the next part. So this is how you have to read it. So here also the definition is very lengthy. We will not make an attempt to understand the entire definition in one go. So what we will try to do is we will try to divide this entire definition into different parts. Each part we will understand so that we get a complete clarity of the entire term audit. So what they are trying to say. So I have already at the time of reading the definition only I have highlighted the important terminology here. Let me highlight it once again here. So the key terms which are used in the definition of audit are: number one, independent examination. Number two, they are using something called financial information. Number three, they are telling profit, whether profit oriented or not. Then they say irrespective of size or legal form. Then they use the term something called expressing an opinion. So these are the key terms which are used in the definition of audit. If we get to understand the meaning of these terms, then obviously the entire definition of the audit also becomes very clear. So what they are actually trying to say here, first thing they say, audit is an independent examination. What is the first term they are saying here? What actually happens in the audit? In the audit, examination is going to happen. What exactly is going to happen in the audit? Examination. If I say I am doing audit, I will do examination there. So what is the meaning of the term examination here? The meaning of the term examination could be verification. You are actually trying to verify something, or you are trying to inspect something. You are trying to check something or inspect something, or you are checking something, or you are scrutinizing something. So when I say I am executing a function of audit, so basically what is the major activity that will happen in the audit is verification, examination, checking, scrutinizing, inspecting. So basically audit involves examination, checking or verification. And that is not an ordinary examination, that is an independent examination. What kind of examination it is? It is an independent examination. Sir, what basically is the meaning of independent examination? Sir, what is the general meaning of the term independent? The term independent means free from influence. See, we often use this term independent or independence in our common conversations also. Like I say, if I'm an independent person, or so and so person is independent, I'm independent on my own. So these kind of things we often hear. We use the term independent or independence in our common conversations also. But from the perspective of the audit, the meaning of the term independent is free from influence. What is the meaning of the term independent? Free from influence. That means independence is, I can call it as, it is an ability, it is a characteristic, it is a nature of a person to be free from influence. That means especially when you are taking decisions, you should not change your decisions being influenced by others. So the ability to take the decisions without any influence of other parties. So that quality, that nature, that characteristic of a person, I am going to call it as independent. I call that person as independent. Like for example, if I am verifying something, if I have to give my opinion on something, if I feel something as right, I have to say it as right. If I feel something as wrong, I have to say it as wrong. Before taking my decision, before saying something as right or wrong, I should not think what other person will take my opinion as. If I say something is wrong, the other person might take me for wrong, the other person might get hurt, the other person might not receive it properly. So the moment that kind of thought is coming to your mind, so if I give this opinion this way, how the other person will receive it, the other person will get affected, the other person will feel bad about me. That's why I will not give what is the correct opinion. I will say something which I don't agree with. So then you are not independent actually. So the ability to take the decisions without any influence from the third party. If you feel something as correct, you have to say it as correct. If you feel something as wrong, you have to say it as wrong. Before saying your opinion, you should not get influenced by other party. So that ability to take the decision without coming under influence of anybody, that we call it as independent. Like for example, if I have to express some opinion about my father, if I have to express some opinion about my father, if I have to say something about my father, I feel that if I say something bad about my father, he might feel bad. He might get hurt. So I will say some inappropriate thing. Even though if I have to say something as wrong, because I have something in my mind that my father will feel bad about whatever I'm trying to say, I will change my opinion. Then I'm not independent. Why? Because while taking decision, I am under influence of another person. I am not independent. So if I am free from influence while taking decision, I am not giving importance to other person's wishes, feelings or directions, whatever feels correct to me, I am saying that that nature I will be calling as independent. So when I say audit, what actually happens in the audit is going to involve examination. Examination means verification, checking or scrutinizing, and that is not an ordinary examination which happens in the audit. It is an independent examination. Sir, what is an independent examination? Free from influence, ability to take the decisions without any influence of others. That nature we are going to call it as independent. Okay, so we understood what is an audit, what happens in the audit. So audit, independent examination is going to happen. Sir, but what is the thing you are going to examine? Agreed, in the audit, you are going to verify, and that verification you are going to do it independently. But what is the thing you are going to verify? That is addressed in the next part of the definition. They say it is an independent examination of financial information of an entity. So what exactly an audit is trying to verify? Financial information. So let us try to understand what is the meaning of this term financial information. Let us try to understand what is the meaning of this term financial information. See, we often hear the term financial statements. We often hear the term what? Financial statements. And even there is one important inclusive definition for the term financial statements. Under Companies Act 2013, see, generally definitions can be divided into two categories: exhaustive definitions, inclusive definitions. Exhaustive definition like audit, you can say. So audit could be an exhaustive definition because they are exactly telling what is included or what exactly happens in the audit. So some definitions could be inclusive definitions also, where they don't define what is exactly the term, but instead they say what will be included in the term. So you might have seen those kind of definitions, inclusive definitions, at various places in your accounts, in your taxation. So at various instances you might see. So financial statements is also inclusive definition given under Companies Act 2013, and it is one of the famous and popular definition of the term financial statements. So if I ask you, what is financial statements? So the definition as per the Companies Act is, they say financial statements includes, they're not telling what exactly is the meaning of the term financial statements, but instead they are telling what will be included in the financial statements. They say that in the financial statements, it will include the balance sheet. It will include the statement of P&L. It will include the statement of cash flows. It will include the statement of changes in equity. It will also include notes to accounts. Will also include what? Notes to accounts. So financial statements includes these items. So what will be included in the what will be included in the term financial statements? It includes balance sheet, which shows financial position. It includes statement of P&L, which shows financial profitability. It also includes cash flow statements, which shows whether you had a net cash outflow or cash inflow during the year. Similarly, we have statement of changes in equity, which will show you the reasons for increase or decrease in the equity balance during the year. See, equity means simply the share capital along with the reserves and surpluses. That cumulative balance we are going to call it as equity. So simply what the statement of changes in equity will show is the reasons for difference between opening and closing balance of equity. See, like the way cash flow statement, what does cash flow statement show? The cash flow statement shows the reasons for difference between opening and closing balance of cash and cash equivalents. And that differences will be divided into three categories: cash flow from operating activities, cash flow from financing activities, cash flow from investing activities, right? So cash flow statement is showing the reasons for difference between the opening and closing balance of cash and cash equivalents. Similarly, the statement of changes in equity is also a statement which will explain the difference between opening and closing balance of equity. Sir, what is equity? The cumulative balance of share capital along with the reserves and surpluses, that only we call it as equity. For example, open equity balance for the financial year 22-23. So as on 1/4/2022, the opening share capital was 100. The opening reserves and surpluses was 50. The total opening equity was 150. As on 31st of March 2023, the share capital was 120, the reserves and surpluses was 70, the closing equity was 190. So we have a total increase of 40 crore rupees in the equity balance. Now I will present one statement which will explain me what are the reasons for that increase of 40 crores in the equity balance. That statement which shows the reasons for difference between opening and closing balance of equity, that only I call it as statement of changes in equity. Then we have something called notes to accounts. Notes to accounts contains all important disclosures related to the financial statements, relating to the balance sheet, P&L, cash flow statements, etc. And also the notes to accounts contain breakup of the information which is there on the face of the balance sheet and P&L. For example, on the balance sheet, you are able to find something called inventory. Inventory 100 crores is there. Now I want to know, in this inventory of 100 crores, how much is raw material, how much is work in progress, how much is finished goods, how much is stores and spares. I want to know the breakup. Sir, where I will get to know the breakup? That breakup you will get to know it in the notes to accounts. Similarly, the client, while preparing the financial statements, the management, while preparing the financial statements of any entity, what accounting policies they have followed. For example, revenue, for recognizing revenue, what policy they have followed. For charging depreciation, what accounting policy they have followed. How they have valued the inventories, how they have valued their fixed assets. So whatever accounting policies which the client has followed, whatever accounting principles which the client has followed in the preparation of the financial statements, all that accounting policies also will be disclosed in the notes to accounts. All those accounting policies also will be disclosed in notes to accounts. So this is what will be included in the term financial statements, which includes 5 components: balance sheet, P&L, cash flow statement, statement of changes in equity, and notes to accounts. First of all, why we came to financial statements, why we understood financial statements, where our discussion started from. So we are actually discussing something called definition of audit. In that definition of audit, we understood one part. In audit, what will happen? Independent examination will happen. Of what? In the definition, they told in the audit we are going to independently examine financial information. But I did not explain you the definition of the term financial information. I told you, or I in fact reminded you, what is the definition of the term financial statements. But the term financial statements, what was not used in the definition, the term which is used in the definition of audit is financial information. Sir, you told financial statements, but the definition used in the term used in the definition is financial information. Are both one and the same? The answer is no. Financial statements and financial information are not one and the same. In fact, financial information is a very broader term. Financial information is a very broader term. In that, one of the component is financial statements. In that, one of the component is what? Financial statements. If I put it in other way around, there are financial statements. Now, to this financial statements, if you add the source data, to this financial statements, if you add source data, see, for the preparation of the balance sheet, for the preparation of the P&L, for the preparation of the cash flow statements, there will be some source data, no? On the basis of which these financial statements are prepared. Sir, what is the source data for the preparation of financial statements? From what source you will prepare this balance sheet, P&L, cash flow statement, statement of changes in equity? Simply on the basis of books of accounts. So this financial statements added to their source, which is books of accounts, this entire collective information, we are going to call it as financial information. So actually, financial information is a very broader term which includes financial statements as well as the source data which is used for the preparation of financial statements. That is the financial statements along with the books of accounts, that complete comprehensive information, I am going to call it as financial information. So why we understood financial information? Why? Because our objective is to understand the definition of audit. Yes or no? So why we understood financial information? Why? Because our objective is to understand the definition of audit. So one thing got cleared. Sir, what we are going to verify in the audit? We are going to verify financial information of any entity. So any of the entities' financial information we are going to verify. And that verification we are going to carry out independently. So till here, this part of the definition, till here, everybody clear? So what they have told, the definition of audit: an audit is an independent examination of financial information of an entity. Till here, I hope everybody is comfortable. Now, let us address the next part of the definition. Sir, what is the next part of the definition? Now, this is something called whether, whether profit oriented or not. What is the next term they are using? Whether profit oriented or not. That means now in this part of the definition, they are talking about the profit orientation of that entity whose financial information you are verifying. And they are using the phrase whether profit oriented or not, which indicates that, or let me ask you the question, when they say whether profit oriented or not, what do they mean? Are they telling the profit orientation of the client matters, or the profit orientation of the client doesn't matter? They are telling the profit orientation of the client doesn't matter. Sir, what is this? Very simple. See, any entity in this world, you can divide it into two categories. Whatever entities are there, be it business entity, whatever entities are there, whatever organizations are there, we can divide them into two categories. One is profit oriented entities. Other one is non-profit oriented entities. Sir, what are profit oriented entities? Those entities which are in which have been started with the intention of making profits. Those entities we call them as profit oriented entities. Take for example Reliance Industries Limited, profit oriented entity. Tata Group of companies, profit oriented entity. So like that, you take so many organizations, 90% of the organizations in the world will be started with the intention of making profits. Now, not every organization will be started with profit intention. There might be some organizations which might not have any objective of making the profit. Take for example charitable institutions, or take for example old age homes, or take for example this orphanages, or take for example political parties. Political parties, some people might contradict with me, but theoretically, when we talk theoretically, even political parties also might be started with non-profit orientation. So I know most of the people will not agree with me, but let us keep that discussion aside. So there will be some kinds of organizations which will be started with the without any profit orientation also. So now they are using the phrase in the definition of audit, whether profit oriented or not, which means the entity whose financial information you are verifying independently, whether that entity is a profit oriented entity, whether that entity is a non profit oriented entity, that is not going to change my audit. That means the profit orientation of my client doesn't matter, which indicates that if I am conducting audit of a profit oriented entity, there also I will do independent examination of financial information. If I am conducting audit of a non-profit oriented entity, there also I am going to independently examine financial information only. See, if I am appointed as auditor of Reliance Industries Limited, which is a profit oriented entity, what I will do, Reliance Industries Limited is going to maintain some books of accounts. They will have their financial statements. I will go independently examine this financial information. Similarly, if I am appointed as auditor of some charitable institution, or if I am appointed as auditor of some religious institution, there also what I will do, there also that respective charitable organization or non-profit oriented entity, they will also maintain books of accounts. They will also prepare financial statements. Might be the financial statements prepared by the Reliance Industries Limited, they might include balance sheet, statement of P&L, etc. Whereas the financial statements of charitable institution might include the balance sheet, income and expenditure, receipts and payments account. But whatever it is, if I am getting appointed as auditor of Reliance Industries Limited, I will verify the financial information of Reliance Industries Limited. If I am conducting audit of any charitable institution, there also I am going to independently examine the financial information only. So the profit orientation of the client is not going to have impact on my audit, is not going to change altogether my audit. Whatever I do in the Reliance Industries Limited audit, the same thing I will do it in the case of a non-profit oriented entity like any charitable institution also. So the point is the profit orientation of your client doesn't matter for the audit. Understood? So till here everybody clear with the definition? So what we have understood till now, the definition of audit: an audit is an independent examination of what? Financial information of any entity, whether profit oriented or not. That is, whether the client is a profit making entity, non-profit making entity, that doesn't matter for audit. Next one, irrespective of size or legal form. What is the one more term they are using? Irrespective of size or legal form. So two terms they are using: size, legal form. Size, legal form. And they are telling irrespective of size or legal form. See, you tell me, when they say irrespective of size or legal form, what do they mean? Do they mean size and legal form will have an impact on the audit, or doesn't matter for the audit? Once again, they are telling the size of the entity, the legal form of the entity doesn't change altogether my audit. So size of the client, legal form of the client doesn't matter for the audit. Sir, what do they mean? Let me try to explain it with the help of example. Take for example, India's biggest conglomerate, we have Reliance Industries Limited, which is making 6 lakh plus crores of turnover. See, if I am appointed as auditor of Reliance Industries Limited, what I will do? So this Reliance Industries Limited, which is having a turnover of 6 lakh plus crores of revenue and having lakhs of employees, if I am conducting audit of this Reliance Industries Limited, what I simply do is I will verify their books of accounts, which is financial information. financial information and books of financial statements and books of accounts, I'm going to verify their financial information. Assume that there is one small company X Limited in my locality, wherever I stay. There one small company is there at the corner of my residential house. So now that small company X Limited is hardly making a turnover of 1 crore for the entire year. Their revenue is 1 crore. There are only 2 employees and they hardly make a profit of 10 lakh rupees. Now, if I am conducting, if this company has asked me to act as their auditor, what I will do? This company will also maintain books of accounts. This company also will prepare financial statements. This financial information I am going to verify. So whatever I'm going to do in the audit of the client X Limited, which is a small size of company, the same thing the same thing I will do even in the audit of so-called biggest conglomerate of India. There also I'm going to do the same thing, verify their financial statements and books of accounts. So I will not do something extra in Reliance Industries Limited, which I will not do in the case of X Limited. So in both the cases, my objective will remain the same: do the independent examination of that particular client's financial information, be it a small sized organization, be it a biggest organization. So size of the client doesn't matter, doesn't have a big impact on my audit. Clear? Next one. So what is legal form? Now they are telling irrespective of legal form, even legal form of the client also doesn't matter. Even legal form of the client also doesn't matter. Sir, what do you mean by legal form of the client doesn't matter? Sir, first of all, what is a legal form? Legal form is a legal structure. Legal form is a legal structure, nothing but a legal validity given to some client. How the entity is legally recognized. For example, if I want to start my business, I can start it as a sole proprietor. If I have enough of capital, if I know I could manage everything, I will start it as a sole proprietor. If I want to take the help of my partners or relatives, I can start a partnership firm, or I can take up the route of LLP, or I can start a company, or I can start a society. So nothing but the legal structure, how my organization is legally recognized, that I call it as a legal form. Now they say irrespective of legal form, which means what? Even legal form of your client also doesn't matter for the audit. For example, if I am doing the audit of a sole proprietor, for example, I want to carry out this coaching activity. So I want to conduct some classes. So I want to start this organization. I am starting it as a sole proprietor. I'm starting it as a sole proprietor. So being a sole proprietor, what I will do? I will record these lectures. I will sell them. I will have employees. I will manage the business. Similarly, if I've started this coaching organization as a company, there also what I will do? I will record the lectures, I will sell them, I will have employees to manage them. So the activities will remain the same. So irrespective of the legal organization, or you take another example. For example, if someone is starting a garments business, if they are starting as a sole proprietor, what they will do? They will buy the garments, they will sell the garments, make money, run the business. If a company is carrying out the garments business, then also the activities are going to remain same. See, if I am appointed as auditor of a sole proprietor, what I will do? See, this sole proprietor will maintain books of accounts. This sole proprietor will prepare financial statements. Those books of accounts and financial statements I will verify independently. See, if I am conducting audit of a company, there also what I will do? This company will maintain books of accounts. From that, they will prepare financial statements that I will verify, and I will do that verification in an independent manner. So might be in the case of sole proprietor, the format of the financial statements might change. They might prepare a T format of balance sheet and P&L. In the case of company, they will prepare financial statements, but there you might be able to find a vertical format of the balance sheet. But whatever I do in the case of a sole proprietorship firm, that is independent examination of financial information, the same activity even I will do it in the case of a company also. So you tell me, is a legal form altogether changing my scope of the audit? No. So whatever I do in the sole proprietor, the same thing I will do it in the case of company also, verifying the financial information independently. So that's why the phrase irrespective of size or legal form, which means even size of the client doesn't matter, legal form of the client also doesn't matter. Understood? Clear and comfortable, everybody? So that is what that part of the definition which is saying irrespective of size or legal form. Till here everybody clear with the definition? So what they have told, audit is an independent examination of what? Financial information of an entity. Whether that entity is profit oriented or not doesn't matter. What is the size of the entity doesn't matter. What is the legal form of the entity, that also doesn't matter for the audit. Sir, when you are doing all this independent examination, you told audit involves verifying, we are going to verify the financial information and all. But what is the ultimate objective of doing it? See, when we do any activity, we need some outcome out of it. So if we are doing any activity, there should be some ultimate outcome out of it. Similarly, if we are doing audit, if we are doing independent examination of that financial information, there should be some final outcome of that entire audit process. See, we are not doing the audit for time pass. Definitely no. We are not doing the audit for time pass. So when we have done the audit, there should be some ultimate outcome of the entire audit process. Sir, what is the ultimate outcome of the entire audit process? That is addressed in the last part of the definition, which says when such examination is conducted with a view to express an opinion thereon. So why are we doing this entire process of audit? What is the ultimate outcome of the entire process of audit? What is the ultimate objective of the entire process of audit? They simply say the ultimate objective, the ultimate purpose of the entire process of the audit is to express an opinion thereon. Sir, on what you are going to express the opinion? So you are going to express the opinion on whatever you have verified. So they are telling with a view to express opinion thereon. So ultimate objective is to express the opinion. On what you are going to express the opinion, whatever you have verified, on that only will express the opinion. And what you have verified, financial information you have verified. So you are going to express an opinion on financial information only. So the ultimate objective, the ultimate outcome of the entire process of audit is to express an opinion, to give an opinion. On what you will give opinion? On the financial information you are going to give the opinion. On what you are going to give the opinion? On the financial information you are going to give opinion, because that is the thing you have verified. Now we need to go a bit deeper into this opinions. See, you take any opinion in this world, not just the opinion in audit. You take opinion regarding any object, any person, anything, any place. We can have only two kinds of opinion. So you take any opinion regarding any object, anything, any place, any situation, you will have only two opinions. Either you will have a good opinion or you will have a bad opinion. Either you will have a good opinion or you will have a bad opinion. That's it. No. Like for example, you are watching my classes. Someone asked you, boss, how did you feel the lectures of this faculty? If you like the lectures, you will say the classes are good. If you don't like the lectures, you will say the classes are bad. So either a good opinion or bad opinion. Or if I put it in other way around, so there will be only two kinds of opinion, either good or bad. If I put other way around, you can also call it as positive opinion. You can also call it as negative opinion. Or take for example, if I gave you some food, asked you to taste it and tell me your opinion. What opinion you will give? If you like the food, you will say the food tastes good. Good opinion, positive opinion. If you don't like the food, you will say no, this food tastes worst. Bad opinion, negative opinion. Or if a friend asked you how he or she is looking in a newly bought dress. So if you like her or him in that dress, you will say yes, this dress is looking very good on you. If you don't like it, you will say no, this dress is not suiting you, it's looking very bad. So any opinion regarding anything, any subject, any object, any situation, any place can be only of two types, either a positive opinion, negative opinion, either a good opinion or bad opinion. Even audit is also not an exception for it. Even audit is also not going to be an exception for it. Even whatever opinion that has been expressed in the audit will also be of only two types, either a positive opinion or negative opinion. Sir, what is positive opinion? What is negative opinion in audit? Very simple. What you have verified? Financial information. See, whatever financial information of the client that you have verified, if that financial information does not contain any mistakes, if that financial statements have been correctly prepared, if that financial statements are not misleading, verified the financial information, you found that the financial statements are prepared properly, they are prepared as per schedule 3, they are prepared as per accounting standards, the profit is correct, total assets are correct, depreciation is correct, all the calculations are correct, notes to accounts are correct, everything is correct, there is no wrong information getting conveyed, they are not misleading to anybody, then you will say yes, financial statements are okay, financial information is okay, they are not misleading, they give a true and fair view. What you will say? They will give a, they are giving a true and fair view. So when you verified the financial information and when you are satisfied with it that it is not misleading, it is correct, it is containing correct information, there are nothing wrong there and it is not misleading, then you will say something called financial statements will give a true and a fair view. That is actually a positive opinion. I am giving a good opinion, a favorable opinion I am giving. Favorable opinion I am giving. I verified financial information, they are not misleading. In every aspect, they are fine. However, if you verified financial information and in that financial information you are not satisfied, like profit is calculated wrongly, assets are not totaled correctly, and the format is not as per schedule 3. Some disclosures required by accounting standards are not given, and you concluded that financial statements are actually misleading. They are not showing a correct picture, they are giving a wrong picture, they are giving a misleading information. If you found that, you will say the financial statements are not giving true and fair view. You say the financial statements does not give true and fair view, they are misleading. So that opinion we call it as a negative opinion, bad opinion, or unfavorable opinion. Understood? So but actually this is not actual terminology, positive opinion, negative opinion. This we have used it for the sake of our convenience, but in fact there are technical terms, technical names associated with this positive opinion and negative opinion. That technical names we will actually learn it as a part of our audit reporting chapter. So when we take up the audit reporting chapter, then we will get to understand the technical terms, but for the time being we will remember, for our continuation of the discussion, we'll remember it in a simple terms. You remember either as a good opinion or bad opinion or positive opinion or negative opinion. So the ultimate objective, the final outcome of the entire process of that independent examination is to express an opinion. Who will express opinion? Whoever has verified the financial information, that is simply auditor. That person will express the opinion. On what he will express the opinion? On the financial information he will express the opinion, and that opinion can be of how many types? Two types, either a positive opinion or a negative opinion. So with this, we have completely understood the definition of the term audit. By now, I think you would have already memorized the definition of the term audit. So tell me guys, what is the definition of audit? An audit is an independent examination of financial information of any entity, whether profit oriented or not, irrespective of its size or legal form. When such an examination is conducted with a view to expressing an opinion thereon. As simple as that. So by now we have become clear with what is the definition of, what is the meaning or definition of the term audit. As a part of that, we have understood independent, we have understood what is financial information, we understood what is financial statements and books of accounts, we understood what is profit orientation, size, what is the meaning of the size here, what is the meaning of the legal form here, and also what is the ultimate outcome of the entire process of the audit. So all the basic terms associated with the definition of audit also we have got a good and clear understanding, which I hope so. Clear everybody? So now we will proceed ahead and try to understand the next part of the chapter. So now let us proceed further with the next part of the chapter. So the next part of the chapter which we are going to discuss is what are the overall objectives of audit. So what is going to be the overall objective of audit, so that we are going to expand it a bit further. See, just in the discussion, whatever we are done with, I have already explained the ultimate objective of the auditor is to express an opinion. Sir, on what he is going to express the opinion? On the financial information he is going to express the opinion. So the ultimate objective of the audit or auditor is to express an opinion, and that opinion in fact is required to be expressed regarding two matters. The ultimate objective is to express an opinion, but that opinion is required to be expressed regarding two matters. Sir, which two matters? The two broad objectives of the auditor are to express an opinion whether the financial statements are free from material misstatements, and also whether the financial statements are prepared as per applicable financial reporting framework. So these are the two objectives of the auditor, to express an opinion, and that opinion about two things: whether financial statements are free from material misstatements and whether the financial statements are prepared as per applicable financial reporting framework. See, in each of the objective, if you see here, once again we are stuck with new terminology. So in the first objective, they are trying to say something called material misstatement. So to understand what is this first objective, first we need to understand what is the meaning of this term material misstatement. Now in the second objective, they are telling whether financial statements are prepared as per applicable financial reporting framework. In order to understand the second objective, first we need to understand what is applicable financial reporting framework. So now we will be shifting our focus to understand these new terms, so that our overall understanding of the objectives becomes very clear. So first I will start with the second objective. In the second objective also, first I will try to understand what is the meaning of the term applicable financial reporting framework. Applicable financial reporting framework, what is the meaning of the term? That we will try to understand. See, we will try to divide this term also into different parts. First, what is the meaning of the term framework? Have you heard about this term framework? You might have seen, you might have already come across this term framework earlier. So could anybody tell me what is the general meaning of the term framework? So the general meaning of the term framework is rules and regulations. a set of rules and regulations to do some activity, to do some process. That set of rules and regulations, I'm going to call it as framework. For example, if I am telling you to watch this marathon, you have to follow a set of instructions. So that set of instructions or that set of rules and regulations to watch the class, I will call it as framework for the class. Understood? So simply the term framework means set of rules and regulations. Then what is the meaning of the term financial reporting? See, the term financial reporting means the process of preparation and presentation of the financial statements. That entire process I am going to call it as financial reporting. So what is the meaning of the term financial reporting? The process of preparation and presentation of financial statements. We call it as financial reporting, just an other name for the accounts only. Accounting process. So framework means set of rules and regulations. Financial reporting means the process of preparation and presentation of financial statements. Then you tell me what could be the meaning of financial reporting framework. What could be the meaning of the term financial reporting framework? Very simple. We have to join the two meanings. So if the financial reporting is a process of preparation and presentation of financial statement, framework is a set of rules and regulations. Financial reporting framework means simply the set of rules and regulations which are required to be followed in the process of preparation and presentation of financial statements. That's it. The set of rules and regulations which you are required to follow in the process of preparation and the presentation of the financial statements, I am going to call it as financial reporting framework. Sir, any examples? Very simple. If you have to prepare the financial statements, will you follow certain rules and regulations? Yes. Take for example, I will follow something called accounting standards. Accounting standards are nothing but a set of regulations which you are required to follow the preparation of financial statements and books of accounts. So accounting standard is an example of financial reporting framework. Or you take schedule 3. Schedule 3 is also an example of financial reporting framework. Nothing but it is a set of rules and regulations which will be followed. So that is what the meaning of financial reporting framework, rules and regulations which you are required to follow in the preparation and presentation of financial statements. But they use the term something called applicable financial reporting framework. We understood what is financial reporting framework, but the term which they are using is applicable financial reporting framework. So now what is the meaning of the term applicable financial reporting framework? Let us try to understand it. See, before I explain what is the meaning of applicable financial reporting framework, I have a question for you all. So my question is, who will prepare financial statements? Preparation of financial statements is whose responsibility? Will the auditor prepare the financial statements? Never. So the preparation of financial statements is actually the responsibility of the management. The management of the organization is responsible for the preparation of the financial statements. Like if you take Reliance Industries Limited, the financial statements preparation and presentation is the responsibility of management of Reliance Industries Limited. So always remember, the preparation of financial statements is the responsibility of the management. Auditor is not responsible for preparation of the financial statements. Theoretically, auditor is not responsible for preparation of financial statements. Sir, then what auditor will do, sir? So once the management has prepared the financial statements, then the auditor is going to verify them. And the auditor is going to verify them. So one thing I want you all to be clear, it is whose responsibility to prepare the financial statements? It is always the management responsibility to prepare the financial statements. Clear, everybody? Now, the meaning of the term applicable financial reporting framework is depending on the nature, the purpose of the financial statements, depending on the purpose and also depending on the nature and purpose of the financial statements, the management of the organization will adopt a set of rules and regulations which will be suitable for them. That adopted rules and regulations by the management in the preparation of financial statements will be called as applicable financial reporting framework. So what they are trying to say here, once again I will repeat, depending on the nature of the financial statements, depending on the purpose of the financial statements, the management of the organization will adopt, that is, they will choose which framework will be suitable for them, and they will adopt that framework adopted by the management, that we are going to call it as applicable financial reporting framework. I will give you examples to make you understand in an even better way. Take for example the management of Reliance Industries Limited. Who is responsible for preparation? Management. So the management, while preparing financial statements, keeping in mind the nature of the organization, they thought that the nature of our organization is company. So since the nature of our organization is company, we will follow Schedule 3 and accounting standards in the preparation of financial statements. Who adopted? Management themselves adopted. Auditor will not adopt, guys. Who has to adopt? Management of the organization themselves has to adopt. They themselves has to choose which set of rules and regulations they have to follow, and on what basis they will choose. On the basis of nature and purpose of the financial statements. So the management of Reliance Industries Limited, depending on the nature of the organization, they have adopted Schedule 3 and accounting standards. They told they will follow Schedule 3 and accounting standards in the preparation of financial statements. So this becomes applicable financial reporting framework for Reliance Industries Limited. Now, another example, SBI. The management of the SBI is responsible for preparation of financial statements. The management, while deciding to prepare the financial statements, keeping in mind the nature of the organization is banking company. Since the nature of the organization is banking company, the management of SBI thought that we will follow a banking regulation act in the preparation of the financial statements. Then banking regulation act becomes applicable financial reporting framework for SBI. Now, Max Life Insurance Company, keeping in mind the nature of the company, the management, since it is an insurance company, the management has chosen they will follow IRDA rules and regulations in the preparation of the financial statements. Now, IRDA rules and regulations will become applicable financial reporting framework for Max Insurance. So like this, depending on the nature of the organization and the purpose of the financial statements, the management themselves will adopt a framework which will be suitable for them. That adopted framework, we are going to call it as applicable financial reporting framework. Very, very important, guys. They might ask you true or false statements. So if you have a look at the material, you will see the definition of what is applicable financial reporting framework. So if you see this phrase, in view of nature of the entity and purpose of the financial statements, the management of the entity will adopt applicable financial reporting framework. This is what the correct statement. In the examination, they will ask you true or false statements. What they will do, they will say, listen carefully. In view of nature of the entity and purpose of the financial statements, the auditor of the entity will adopt applicable financial reporting framework. So they will just replace this word management with the auditor and pose a question as true or false statement. So you have to read the question, especially true or false in MCQs. You have to read it minimum twice, then only you have to answer. So auditor will not adopt the applicable financial reporting framework. The management of the organization themselves will adopt the applicable financial reporting framework. And on what basis they will adopt, sir? On the basis of nature of the entity and the purpose of the financial statements. That adopted framework, we are going to call it as applicable financial reporting framework. Everybody clear about this? Right. So this is what the meaning of applicable financial reporting framework. Now we have to extend our discussion to understand something called, to understand the discussion relating to types of framework. Now we are going to proceed ahead and understand the most important concept, various types of frameworks. We are going to understand it. Okay, so without any delay further, let us try to understand various types of frameworks. Once again, I am telling you, this is going to be the most important discussion. If you are not focusing carefully, you will not be able to understand it on your own. So very, very important concept here. Okay, so let us try to understand it. So now coming to the types of frameworks. So first, we will try to understand the frameworks on the basis of purpose. So first of all, on the basis of the purpose of the financial statements can be broadly divided into two categories. So we are going to talk about various types of framework. The first categorization, which I am going to explain, is the frameworks, the division of frameworks on the basis of their purpose. So on the basis of purpose, financial statements can be divided into two categories. Number one, general purpose financial statements, and number two, special purpose financial statements. Sir, what is general purpose financial statements? They simply define that financial statements which are prepared as per general purpose framework will be called as general purpose financial statements. So then what could be the definition of the special purpose framework? See, when they have defined general purpose financial statements are those financial statements which are prepared as per general purpose framework. What would be the definition of special purpose financial statements? You're all smart enough to guess, no? So they have simply told the financial statements which are prepared as per special purpose framework, that we will call it as special purpose financial statements. Very, very simple definitions, no? So general purpose financial statements which are prepared as per general purpose framework. Special purpose financial statements which are prepared as per special purpose framework. Everybody understood? You understood nothing. To understand, first we need to understand what is the meaning of the general purpose framework and what is the meaning of the special purpose framework. That we have to understand. So if we understand what is the meaning of general purpose framework and what is the meaning of the special purpose framework, then our discussion gets complete. So let us try to understand what is the meaning of general purpose framework and what is the meaning of the special purpose framework, that we will try to understand it. So they say that general purpose framework is a framework which fulfills financial information needs of various users of the financial statements. How is the term general purpose framework is defined? They defined it in such a way that the framework which fulfills financial information needs of various users of the financial statements. See, to understand what is the meaning of the general purpose framework, first we need to have a look at who and all are various users of the financial statements. See, I told financial statements will be prepared by management, but its use is done by so many people. Sir, who and all are various users of the financial statements? Take, for example, shareholders. So, sorry, guys. So, first example, the first user of the financial statements will be shareholder. Sir, why the shareholder will use financial statements? Because the shareholder is the person who will invest his money in the company. He wants to know whether the shares will increase in price or fall in the price. And whether the shares will increase the price or decrease the price, that will depend on performance of the company. So the shareholder wants to know about the performance of the company, and how the shareholder will come to know about the performance of the company. The only source which is available for him is financial statements. So shareholder is a user of the financial statements. Prospective shareholder, sometimes the people who want to invest, not yet invested, they want to use the financial statements to know the track record of the company. Government will make use of financial statements to know whether the SSEs are making the proper payment of the taxes. Next one. And even banks and financiers will use the financial statements to determine whether the borrower will be having a repaying capability or not. So even management themselves will make use of the financial statements for their decision making purposes. So management also will be making use of financial statements for their decision making purposes. So management will prepare financial statements and it will be used by different people for different purposes. Now, if I follow one single set of rules and regulations and prepare the financial statements, and if that framework and if that set of rules and regulations, whatever I have followed, if they are going to fulfill financial information needs of various users simultaneously, that framework I'm going to call it as general purpose framework. So once again, if I put it in a simple sense, management will prepare financial statements, there will be different users. If I follow a set of rules and regulations and prepare financial statements, those financial statements will fulfill financial information needs of all the users or various users simultaneously. Such a framework, I call it as general purpose framework. If I give you an example, as I have told, the financial statement users are so many. Shareholders will be users, government will be users, prospective shareholders will be users, sometimes research analysts will be users who prepare the analyst reports on the companies. So like that, different users are there. Now, do you think every company will prepare different set of financial statements? Separate set of financial statement for shareholders, separate set of financial statement for government, separate set of financial statement for prospective shareholder. Do you think for separate entities, separate financial statements, separate user, separate financial statements? No. If you pay attention practically, the companies will generally prepare one set of financial statements using the rules of Schedule 3 and accounting standards, and they will follow this framework and prepare financial statements. If I go and give it to shareholder, will he accept? Yes. If I go and give it to government, will they accept? Yes. If I go and give it to prospective shareholder, will his information needs be fulfilled? Yes. If I go and give it to research analyst, will his information needs be fulfilled? Yes. So here the company is following one set of rules and regulations, in our example Schedule 3 and accounting standards, and that framework is fulfilling financial information needs of the shareholders also, it is fulfilling information needs of the government also, it is fulfilling information needs of the prospective shareholders also, it is also going to fulfill the information needs of the research analyst also. So one framework is followed and it has fulfilled financial information needs of various users simultaneously. Now, can I call this framework as general purpose framework? Yes. Why? Because a single framework is trying to satisfy information needs of various users of the financial statements. Sir, how general purpose framework or why general purpose framework will fulfill financial information needs of various users? Why? Because it follows certain characteristics. Why? Because it follows certain characteristics. So since a general purpose framework follows certain characteristics, that's why it is having the capacity to fulfill information needs of various users. Sir, what characteristics general purpose framework will have? It will have four characteristics. Number one, it will follow generally accepted accounting principles like prudence, concept of materiality. So those kind of generally accepted accounting principles will be followed in the case of general purpose framework. And also the general purpose framework will follow accounting standards. They also will follow fundamental accounting assumptions. We have three fundamental accounting assumptions. What are they? Going concern, accrual, consistency. So this general purpose framework will also fulfill these three fundamental accounting assumptions also. And general purpose framework financial statements will be prepared periodically for a fixed period. General purpose financial statements will be prepared. Like if you take company's financial statements, they will be prepared for a fixed duration of 1 year. The company will not prepare financial statements for 5 months, 7 months, 9 months, etc. They will prepare financial statements for one entire period, that is for one entire financial year. They will prepare the financial statements and then they will release it. So they will be prepared with a fixed periodicity. So since general purpose framework will have these characteristics, they will be accepted by all. So what are the four characteristics of the general purpose framework or general purpose financial statements? They follow generally accepted accounting principles, they follow accounting standards, they follow fundamental accounting assumptions, and even they will be prepared periodically. And that fixed periodicity in India is a year, and that year in India starts from 1st April to and ends on 31st of March. Understood? So this is what the meaning of general purpose framework, which fulfills financial information needs of various users. Sir, now what is the meaning of the term special purpose framework? They defined special purpose framework something like this. They told that the framework which fulfills financial information needs of specific users of the financial statements. That means if we are following a set of rules and regulations, and that set of rules and regulations will fulfill information needs of only one or two specific users, not for all users. We follow certain set of rules and regulations to fulfill information needs of only one or two specific users. Such a kind of framework, we are going to call it as special purpose framework. So let me give you an example to understand. Take for example, there is certain company X Limited, or there is certain company X Limited. Now this company X Limited went to the bank manager and they asked, sir, you take our last 3 years financial statements. We prepared the last 3 years financial statements using our general purpose framework. So last 3 years financial statements we are giving to you. On the basis of that, you give me the loan. Banker told something, sir, whatever general purpose financial statements you have given, that I will keep it aside. But if you expect me to give the loan for you, you do one thing. What you do is you prepare the financial statements on cash basis. You prepare the financial statements on cash basis, then I will give you loan. So why the banker is asking is, why? Because the actual repaying capability will be determined by cash profits, not on the basis of accrued profits. See, whatever general purpose financial statements they have brought to the banker, they have been prepared on accrual basis. But the banker wants to know the real repaying capability. So the real repaying capability of the loan depends on cash profit. For example, if you have 10 crores of accrued profit, there is no guarantee whether this 10 crores is realized in cash or not yet realized in cash. So accrued profit will not determine your true repaying capability. Cash profit will determine your true repaying capability. So that's why the bank manager has asked this company to come back and prepare the financial statements on cash basis. On that basis, he will give you the loan. So this company came back, prepared the financial statements on cash basis, gave it to the bank manager. Bank manager was happy. He gave the loan to the company. Now, if the company takes these financial statements, which are prepared on cash basis, and give it to shareholder, will it satisfy the shareholders' needs? That is, will they accept it? No. If they go and give it to the government and say, on this basis only we will pay the taxes, will the government accept? No. If they go and give it to the research analyst and ask them to prepare the stock market report, will they use it? No. So here the company has followed a framework, that is cash basis of financial statements they have prepared. And this framework is fulfilling only information need of a specific user. Who is that specific user whose financial information need has been fulfilled? So that specific user in our example is none other than banker. It is fulfilling the financial information needs of only one user, which is banker. It is not fulfilling information needs of other users. So that framework, I will call it as special purpose framework. Or if I give you one more example, take for example, a company has been approached by, let me put it this way. There is some company X Limited, okay? This X Limited company want to be acquired by Y Limited. That means Y Limited wants to acquire this company X Limited. Y Limited wants to acquire this company. Let me put it this way. There is a company X Limited. there is another company Y Limited. So this company Y Limited wants to acquire X Limited. So they want to determine the purchase consideration. So what this company Y Limited, this is acquirer. So this company wants to purchase. So this company is the buyer. This company is a seller. So what this company told is, okay, boss, I want to buy your company, but I will pay the consideration on the basis of financial statements which you prepare for the recent 9 months. The year has not yet got over. So April 2023 is a starting year. So the acquisition was supposed to happen in the month of December 23. So what the company Y Limited told is, I will buy your company, but I will pay the purchase consideration which will be determined on the basis of financial statements prepared for this 9 months only. So the management of this company prepared 9 months of financial statements to help this Y Limited company to help the buyer to determine the purchase consideration. Okay. So the management has prepared financial statements taking the duration as 9 months to fulfill the information needs of only one user. If the company takes this 9 months duration of financial statements and give it to the shareholder, will they accept? No. If they go and give it to the government, will they accept? No. If they go and give it to the banker, will they accept? No. So these financial statements which are prepared for a duration of 9 months, it will fulfill information needs of only one specific user. This also I can call it as special purpose financial statements. So special purpose financial statements are prepared as per special purpose framework, and the special purpose framework is a framework which fulfills financial information needs of specific users of the financial statements. Clear everybody? So I have given you examples also here. Clear and comfortable everybody? So these are the two types of frameworks on the basis of purpose of the financial statements. So now let us try to understand, there is one more categorization of the frameworks, and that categorization is on the basis of the presentation. See, whatever the categorization of the frameworks which we have done now, so general purpose framework and special purpose framework, so those have been divided on the basis of purpose. So generally general purpose framework is such framework which fulfills financial information needs of various users. On the other hand, special purpose framework fulfills financial information needs of specific users. So that classification whatever we have done, that is on the basis of purpose. Now on the basis of presentation, the frameworks are once again divided into two more categories. On the basis of presentation, the frameworks are once again divided into two categories. Number one is compliance framework and number two is fair presentation framework. So let us try to understand what is this compliance framework and what is this fair presentation framework with the help of examples. Okay, so we are going to have very important discussion for the coming 10-15 minutes. Please pay full attention. So in order to understand in a detailed manner what is this compliance framework and what is this fair presentation framework. So first I will start my discussion with what is the compliance framework. So we'll try to read the definition from the material. So they say compliance framework is a framework in which the financial statements are prepared as per the requirements of such framework without any deviation. The most important term here is without any deviation. What they're trying to say here, compliance, the name itself says, what do you mean by compliance? To comply with something. So compliance framework refers to such a kind of framework, framework in which you are required to prepare the financial statements as per the requirements of that framework. That means whatever rules and regulations which are given in the framework, you have to prepare the financial statements as per the said rules and regulations. And most important thing here, without any deviation. Deviation will not be permitted. You are not supposed to deviate from the requirements of the framework. So whether by following that rules and regulations, financial statements give a true and fair view, doesn't give a true and fair view, all that is not going to matter. In the case of compliance framework, you are strictly required to adhere to whatever requirements given in the framework. Deviation is not at all permitted. You are not at all permitted to deviate. Whether it gives a true and fair view, does not give a true and fair view, all that doesn't matter. You have to strictly follow the rules and regulations given in the framework without any deviation. Such a framework we are going to call it as the compliance framework. Clear everybody? Like if you take for example in the previous, when we are understanding the general purpose framework and special purpose framework, as I have told, the banker is asking the company to prepare the financial statements on cash basis. See, company knows that if they prepare the financial statements on cash basis, that doesn't give a true and fair view. But still, after knowing that also, the company has prepared the financial statements on the cash basis to satisfy the banker to get the loan from him. Yes or no? So this is an example of compliance framework where the entity knows that by following the certain set of rules and regulations, a true and fair view will not be there, but still deviation is not permitted. If you want a loan from the banker, you have to compulsorily prepare the financial statements on the cash basis. So such a kind of framework in which the deviation is not at all permitted, where you are required to strictly comply with the rules and regulations given there without any deviation, such a framework we call it as compliance framework. Now let us talk about fair presentation framework. Sir, what is fair presentation framework? So if we come back to the material here again, so let us read the definition, what they are trying to say here. So fair presentation framework is the framework in which the financial statements are prepared as per the requirements of such framework. If you see here, the fair presentation framework also, till here, the definition will look similar to compliance framework only. So here also what they are telling, in the fair presentation framework also, we try to prepare the financial statements as per the requirements of the framework only. And the definition will not stop here. The definition also says, and may provide additional disclosures beyond the requirements of the framework, or may even deviate from the requirements of such framework. For what purpose? So as to achieve the fair presentation. So as to achieve fair presentation frame. So as to achieve the fair presentation. So what exactly they are trying to say? See, in the case of fair presentation framework also, there will be certain framework, there will be certain rules and regulations. There also, we try to prepare financial statements as per the requirements of such framework. Whatever has been mentioned in the framework, that we will try to follow. But here we are given some freedom. In the case of fair presentation framework, the user will get a freedom. We get a option. We get a choice. Sir, what freedom we will get? So what freedom the fair presentation framework will give is, so you try to prepare the financial statements as per the requirements of such framework only, but we will give you some freedom. We will give you some extra permission. What extra permission will be given? Option number 1, we will give you permission to provide additional disclosures. May contain additional disclosures which are not required as per the framework. Or we will also give you permission to may deviate from the requirements of such framework altogether. Here also you try to prepare financial statements as per the requirements of the framework, but we will give you option. What option we will give you? You can either provide additional disclosures, you can either add extra explanation in your notes to accounts, or in some circumstances we will also give you permission to deviate altogether. That means don't follow the framework and follow something out of your own choice. But why this permission we are giving you? Why we are giving you the permission to provide additional disclosures? Why we are giving you the permission to deviate from the requirements of the framework? The ultimate objective is to achieve fair presentation. So what is the ultimate objective? So we are giving you that permission to provide additional disclosures, or we are giving you the permission to deviate from the requirements of the framework to achieve fair presentation. Able to understand? See, the name itself says fair presentation framework. You are required to ensure that the financial statements give true and fair view. So in the case of fair presentation framework, the focus is on true and fair view. Whereas in the case of compliance framework, following strictly is the objective. So I will try to give you example to make you understand this compliance framework and fair presentation framework. We will do one quick example. Take for example, there is an entity X Limited. There is a company X Limited. Now this company X Limited has bought some plant and machinery. This company X Limited has bought some plant and machinery. The total cost of the machinery is 1 crore rupees. What is the total cost of the machinery? 1 crore rupees. Now, when an entity has bought a plant and machinery, when an entity has bought a fixed asset, they are required to charge depreciation. They're required to charge depreciation. So now for charging depreciation as per the Companies Act, as per the Schedule 3, so the financial reporting framework says for charging depreciation, two of the methods are allowed. Either the client can follow SLM method or the client can follow WDV method. So the company has bought a plant and machinery, and on that they have to charge the depreciation. And as per the framework, as per the Companies Act, either of the two methods are permitted. Either charge the depreciation on SLM basis or charge the depreciation on WDV basis. And even you are well aware, under the Companies Act, they have even given the percentage of depreciations also, rates of depreciation also they have given. Take for example, as per the Companies Act, if you follow SLM method, the depreciation rate is 15%. If you follow WDV, the depreciation rate is 20%. So if it is a compliance framework, then you need to strictly follow either SLM or WDV. So if I follow SLM, the depreciation will be 15 lakhs. If I follow WDV, the depreciation amount will be 20 lakhs. So if it is a compliance framework, deviation will not be permitted. You are required to follow either SLM or WDV as given in the framework. But now let me add some extra information. So when it comes to usage of this plant and machinery, this plant and machinery was designed in such a way that it is going to exactly produce 1 lakh units, and after producing 1 lakh units, this machinery will stop working. This plant and machinery has been designed in such a way that this will exactly produce 1 lakh units. After that, it will stop functioning. So such a machinery it is. So, and if you look at the consumption pattern, if you look at the way the machinery is getting used, some more method of depreciation looks more appropriate. Apart from SLM and WDV, when we look at the consumption pattern, the machineries are designed to exactly produce certain number of products or units. So keeping in mind the consumption pattern, some more method of depreciation will be more suitable. Sir, which method will be more suitable? Production units method will be more suitable. Production units method will be more suitable. That betterly reflects the consumption pattern. So assume that in year 1, the using that machinery, some 25,000 units were already manufactured. In the year 1, using that machinery, 25,000 units were already manufactured. So if you tell me, if you follow production units method, what will be the amount of depreciation? The amount of depreciation will be 1 crore into 25,000 divided by 1 lakh units. So if you calculate it, 25 lakhs will be the amount of depreciation. Yes or no? So now we have 3 options. Applicable financial reporting framework says either follow SLM or WDV. Whereas if you look at the consumption pattern, some more method of depreciation is looking appropriate. Production units method will be more appropriately reflecting the consumption pattern. If we follow production units method, the depreciation amount would be 25 lakh rupees. So if it is a compliance framework, irrespective of whether the financial statements give a true and fair view, doesn't give a true and fair view, we will straight away charge the depreciation either as 15 lakhs or 20 lakh rupees. No deviation is permitted. However, if it is a fair presentation framework, here if it is a fair presentation framework, the client will be given 2 options. Number 1, if you want, you can provide additional disclosures. If you want, you can provide additional disclosures. Or an option will be given to you to deviate altogether from the requirements to achieve fair presentation. So if it is a fair presentation, how we can give additional disclosure? Let us have a look at it. So what do you mean by giving additional disclosure? See, in this case, what I will do is, in my statement of P&L, I will charge a depreciation either on SLM or WDV. I will show depreciation as either 15 lakhs or 20 lakh rupees. I will follow the requirements of the framework. I will, in my statement of P&L, I will charge a depreciation either as 15 lakhs or 20 lakhs. But what I will do is, in my notes to accounts, I will add an extra explanation. In my notes to accounts, what I will do, I will add an extra explanation. What I will say is, since the requirements of the framework are there, so I have charged depreciation as per SLM or WDV method. But depending on the consumption pattern, some more method of depreciation is appropriate, which is production units. If I would have followed that production units method, the depreciation would have been 25 lakhs. The profit would have been come down by 5 more lakhs. So I will try to comply with the requirements, but what I will do, I will be given a freedom to add disclosure, to add an explanation in the requirements, which is beyond the requirements of the framework. See, the framework is not asking you to give this disclosure, but still I am at my choice to add extra disclosure in the notes to accounts. For what purpose I am adding this extra explanation? I am adding this extra explanation in the notes to accounts to achieve the fair presentation, so that users will get a better presentation of the information. Able to understand? So this permission will be given. So we try to comply with the requirements, but we will be given a permission to add extra disclosure in the notes to accounts for achieving fair presentation. Option number 1. See, one more option will be given in fair presentation framework. We are also permitted to deviate from the requirements of the framework. We are also given the permission to completely deviate from the requirements of the framework. Sir, what do you mean by deviation? If I want to go for the second option, what I will do is, in my statement of P&L itself, directly I will charge the depreciation as 25 lakh rupees. In my statement of the P&L, I will directly charge depreciation as 25 lakh rupees. That means I have deviated. I am ignoring whatever has been mentioned in the framework and I am following something else. I am following something else. I am ignoring whatever has been mentioned in the framework. I am deviating from the requirements of the framework. Sir, why are you deviating from the requirements here? Why am I deviating the requirements is, why? Because this 25 lakhs will give me more fair presentation. Understood? So in the case of fair presentation framework, to the extent possible, we try to prepare the financial statements as per the requirements of such framework. But here, in this case, we will be given an option. Sir, what option will be given? What option will be given is, what freedom will be given is, either we will be given a freedom to add additional disclosures which are not required, And also we are given a freedom to deviate from the requirements. Either we can provide additional disclosures beyond the requirements of the framework, or we are given a freedom to deviate altogether the requirements of the framework and follow something else also. Sir, ultimately, why the freedom has been given? What is the purpose of giving this freedom of providing additional disclosure or deviating from the requirements of the framework? To achieve fair presentation. To achieve what? Fair presentation. The focus is fair presentation. So, on the basis of presentation, these frameworks are divided once again into two categories: compliance framework and fair presentation framework. Clear, everybody? Now, sir, where there will be true and fair view, where we can guarantee always true and fair view. See, in the case of fair presentation framework, there will always be true and fair view. In the case of fair presentation framework, there will always be true and fair view. In the case of compliance framework, true and fair view might not be guaranteed. True and fair view can be there, may not be there. We can't guarantee, but there will always be a true and fair view in the case of fair presentation framework. And one more thing here, most of the special purpose financial statements will be prepared as per the compliance framework, and most of the general purpose financial statements will be prepared as per fair presentation framework. Most of the special purpose financial statements are prepared as per compliance framework, and most of the general purpose financial statements are prepared as per fair presentation framework. And even if you pay attention, every listed company will release the financial statements in the public domain, no? So you will be able to download that financial statements of every listed company on their websites. They are actually general purpose financial statements, and those financial statements which every listed company is releasing, on what framework they have prepared? They have been prepared on compliance framework or fair presentation framework. They all follow a fair presentation framework. They all follow a fair presentation framework. Why? Because section 129 of the Companies Act asks, if you read the provisions of section 129 of the Companies Act, which is talking about the financial statements, it says financial statements shall give true and fair view and comply with the standards and schedule 3. So which means in the case of section 129, the more focus has been given on true and fair view. So that's why whatever financial statements which the companies are preparing, which listed companies will prepare and make it available in the public domain, they all follow fair presentation framework. Clear, everybody? So that is what the differentiation. So once again, if you see here, true and fair view may not be guaranteed, where in the case of compliance framework, but in the case of fair presentation framework, there will always be a true and fair view. Next, most of the special purpose financial statements are prepared as per compliance framework. Then they say most of the general purpose financial statements are prepared as per fair presentation framework. So with this, we are done with the discussion relating to types of frameworks. So how many frameworks totally we have seen? 4 frameworks we have seen. 2 on the basis of purpose. What are they? General purpose framework, special purpose framework. 2 on the basis of presentation. What are they? Compliance framework and fair presentation framework. Why we have come to, from where our discussion started, we have understood types of framework, but where this discussion has actually started, we are discussing something called objectives of the audit. So we told that the objective of the auditor is to express an opinion. That opinion needs to be expressed on 2 things. We came on the second objective, which says whether financial statements are prepared as per applicable financial reporting framework. So first we understood what is financial reporting framework, then we understood what is applicable financial reporting framework, then we understood various types of framework. So what is the second objective on which auditor has to express the opinion? So as an auditor, you have to express the opinion whether financial statements are prepared as per applicable financial reporting framework, which means the management of the client's organization, depending upon the nature of the entity, purpose of the financial statements, they will select which framework will be applicable for them. As an auditor, my responsibility is to verify whatever financial statements which the management has actually prepared, whether they have prepared it on the basis of applicable financial reporting framework. Like for example, if I am conducting audit of a company, and if my client company has adopted Schedule 3 and accounting standards as their applicable financial reporting framework, as an auditor, my responsibility is to verify whether really the client's financial statements are prepared as per Schedule 3 and accounting standards. If I am conducting audit of SBI, the SBI has adopted Banking Regulation Act as their applicable financial reporting framework. If I am an auditor, my objective is to verify whether the financial statements of SBI have really been prepared on the basis of the Banking Regulation Act. So one of the major objective of the auditor is to express an opinion whether financial statements are prepared as per applicable financial reporting framework. Clear? So we are done with the second objective. Now let us come back to first objective. Sir, what is the first objective? The auditor is required to express an opinion whether financial statements are free from material misstatements. So now we need to understand, in order to understand the objective, First we need to understand the meaning of the term misstatements. Sir, what is the meaning of the term misstatements? So if we understand the meaning of the misstatements, then if we understand what is the meaning of the material misstatements, then the first objective also becomes clear. So what is the simple meaning of the term misstatement? Statement means what? Conveying something. Misstatement means what? Conveying something in a wrong way. So simply a misstatement in the financial statements means a mistake in the financial statements. Simple language. What do you mean by misstatement in the financial statements? A mistake in the financial statements in a very simple common language. But as we all know, simple things don't work in the examination. They will give complex definitions for the terms. Similarly, for the term misstatement also, a complex definition has been given. First, I will try to read it. So if you read the definition of the misstatement, what they are trying to say here is the difference between amount, classification, presentation, and disclosure, which is there in the reported financial statements, and the amount, classification, presentation, and disclosure which is required as per applicable financial reporting framework. This is what the definition they have given for the term misstatement. I know you would not have understood anything, but this is what the complex definition. So even after analyzing all this definition also, ultimately we'll come to the conclusion, sir, this is nothing but a mistake in the financial statements. Yes, but as I've told, simple things don't work in the examination. They will always try to complicate it. So let us try to understand what exactly they are trying to say with the help of a few examples. So they say that if there is a difference between amount, classification, presentation, disclosure, which is there in reported financial statements. Reported means what? The financial statements which are already prepared by the management. And amount, classification, presentation, disclosure required as per applicable financial reporting framework. If there is a difference between the two, that difference only we call it as misstatement. The difference between amount, classification, presentation, disclosure in the reported financial statements, and amount, classification, presentation, disclosure which is required as per applicable financial reporting framework, the difference only we are going to call it as misstatement. Sir, what is this? Let me give you examples. Take for example some accounting standard. As per AS 9, the client is required to recognize a revenue as 90,000 rupees. So as the amount required as per applicable financial reporting framework is 90,000. But in the financial statements which are already prepared by the management has recognized the revenue as 1,50,000. So there is a difference in amount which is there in the reported financial statements and the amount which is required as per applicable financial reporting framework. There is a difference. This difference we call it as what? Misstatement. This difference we are going to call it as what? Simply misstatement. Understood? Or there might be a difference in classification. As per applicable financial reporting framework, certain item is required to be treated as capital expenditure. But the management in the financial statements, whatever they have prepared, they have classified it as a revenue expenditure. Difference in classification. This also we call it as misstatement. Or sometimes there might be a difference in the presentation as per applicable financial reporting framework, like schedule 3 if you take. So in the schedule 3 you are required to prepare financial statements in a vertical format, but the client has prepared the financial statements in horizontal format, in T format. There is a difference in presentation. The difference also we call it as misstatement. Or there could be a difference in disclosure also. Sir, what do you mean by disclosure? Disclosure means an explanation in the notes to accounts. So some accounting standard is asking you to give some explanation, whereas in the financial statements which are prepared by the management, either that disclosure is not given or the disclosure has been given in a wrong way. Either some explanation has not been given or that explanation has not been given in a correct way. So that difference also we call it as misstatement. So that is what the definition they are trying to say, the difference between amount, classification, presentation, disclosure which is there in the reported financial statements, and the amount, classification, presentation, disclosure which is required as per applicable financial reporting framework. If there is any difference in any of these items, that difference we are going to call it as a misstatement. Understood, everybody? So once again, simply nothing but a mistake in the financial statements. See, one important concept which I would like to focus here that will help you to understand the remaining chapters also. See, generally whenever we say mistake in the financial statements, if I say there is a mistake in the financial statements, what generally people will assume, what the perception a student will have is, okay, there is a mistake in the financial statement means there is a mistake in the profit, there is a mistake in the assets, there is a mistake in the liabilities. So we all think in numbers. We generally have a preconception that when I say there is a mistake in the financial statements, we always think that there is some mistake in the numbers of the financial statements. I want you to change that perception. When I say misstatement in the financial statements, that misstatement need not always be there only in numbers. The misstatement can even happen in the notes to accounts also. The misstatement can even happen in notes to accounts also. So change this perception. Going forward, when I say there is a misstatement in the financial statements, don't just imagine a mistake happening in the numbers, amounts, balance sheet, etc. A mistake can also happen even in the explanations to the notes to accounts also. Oh, if the management tries to give a wrong explanation, or if they omit some explanation in the notes to accounts, that also constitute a misstatement. So I want you to change that perception now. So misstatement need not always happen in numbers or figures. Misstatement can even happen in the explanations given in the financial statements also. Clear, everybody? So this is what the meaning of misstatement. And a misstatement can happen because of two reasons. Misstatement in the financial statements can occur because of two reasons. Number one is error, or other one is fraud. Error or fraud. So a misstatement in the financial statements can happen because of two reasons, either error or fraud. Sir, what is the differentiating factor between the two? Fraud is something which is done intentionally, with a willingness, with a understanding that the person is committing wrong, still he commits it. So if something is done intentionally, that we are going to call it as fraud, whereas if something happens by mistake unintentionally, that we call it as error. So a misstatement can happen because of two reasons, either on the basis of either that could be because of error, or that could be because of fraud. And the differentiating factor between the two is the underlying intention behind doing that act. Clear? Understood, everybody? So this is what the source from which a misstatement can happen. And if you pay attention to the first objective, they just don't use the term misstatement. In fact, they use the term material misstatement. So if we come back to the first objective, they use the phrase whether financial statements are free from material misstatement. So we understood the term misstatement. Now we have to understand what is the meaning of the term material misstatement. So, sir, what is the meaning of the term material or materiality? Say this term material or materiality is having a lot of significance in our auditing subject. The term materiality is having a lot of significance in our auditing subject. We are going to come across this term at various instances, and it is one of the most important fundamental concept in the audit. So now we will just try to introduce you the term materiality. Later we try to understand in a deeper manner about that materiality. But now we will just understand the basic meaning of the term materiality. See, the general meaning of the term material or materiality, if I call certain item as material, so what do I mean by that? So material means something which is very significant, something which is very important, or something which is very major item. So the general meaning of the term materiality is something significant, important, or material. So they say that the first objective, they say, as an auditor, you are required to express opinion whether financial statements are free from material misstatements, which means that the auditor need not be concerned about each and every minute misstatement. He should be concerned only with material misstatements, significant misstatements. Sir, how to define which misstatement is material, which misstatement is not material? See, there is no hard and fast rule there actually. The term materiality is a very subjective term or relative term in when it comes to audit. It is not an absolute term. So the term material or materiality is a subjective term, or it is a relative term. What is material in each circumstance, that will depends on the facts and circumstances of each and every case. We may not say this amount will be material in all the circumstances. We can't say something like that. Materiality is something which is subjective decision. It changes from entity to entity, industry to industry, audit to audit, client to client. It changes. It is a very subjective or relative term. Like if I give you an example, take for example in the Reliance Industries Limited, which is having 6 lakh plus crores of turnover of company. In that company, you came to know that there is a error worth there is error worth 10 lakh rupees. In the Reliance Industries Limited, which is having a turnover of 6 lakh plus crores, you found that there is a misstatement worth, there is a error of 10 lakhs happened in Reliance Industries Limited. Do you think it is material? No, it is not material. Why it is not material? It is very insignificant. See, even the financial statements of Reliance will be rounded off to the nearest to crores. So this 10 lakhs will not even come as a rounding of error also. So this 10 lakh rupees is not material in the case of Reliance Industries Limited. However, if the same 10 lakh rupees of misstatement is happening some another company X Limited, which is hardly having a turnover of 1 crore rupees, if in that company you came to know there is a misstatement of 10 lakh rupees, is that material? Yes. See here how subjective the term materiality is. Same misstatement, you did not call it as material in the case of Reliance Industries Limited, whereas the same misstatement of 10 lakhs, if it has happened in a small company X Limited having a turnover of 1 crore rupees, then you are saying it is going to be very material. So what is material, what is not material, it all depends on facts and circumstances of each case. But if we have to give one general definition, the act or the standards have given definition something like this: a misstatement will be considered material if it could influence the decision of users of the financial statements. What general definition they have given? A misstatement will be considered material if it could influence economic decisions of users of the financial statements. Because of a misstatement, if the user's decision is getting affected, then only we call that misstatement as material. There is a misstatement but which is not influencing the decision of users of the financial statements, we don't call it as material. Take this example only. Assume you are one of the user, Reliance Industries Limited, you are user of the financial statements of this entity. You are a prospective shareholder. Depending on the performance of the company, you want to invest your money in the Reliance Industries Limited. You downloaded the financial statements, and while looking at the financial statements, you came to know that in this Reliance Industries Limited, there is a 10 lakhs worth of error. You want to invest 1 lakh rupees of money in the Reliance Industries Limited. By coming to know that there is 10 lakh rupees worth of misstatement happened in Reliance Industries Limited, will you stop yourself from investing your money in the Reliance? No. Why? Because looking at the size of the company, 10 lakhs is not at all significant. So even though I came to know there is 10 lakhs worth of misstatement, that is not influencing my decision. That is not having any impact on my decision. It is not material. So a misstatement will be considered if it could influence the decision of users of financial statements. Take for example, I'm a prospective shareholder of the client X Limited. I want to invest my some 10,000 rupees of money in this company. Before I make an investment, I came to know that there is 10 lakhs misstatement has happened in this company. The turnover of the company itself is 1 crore rupees. Now you tell me, will I stop myself from investing my money in the company? Yes. When you came to know there is 10 lakhs worth of misstatement, will you stop yourself from investing your money in the company? Yes, here you will stop investing your money in the company. So now there is a misstatement in the financial statements which has influenced the decision of user of financial statements. So in this case, I can call this as material. So what is material? We can't define exactly, we can't determine a particular amount as material in all the circumstances. It depends on facts and circumstances of each and every case. But the general meaning is a misstatement will be considered material if it could influence the decision of users of the financial statements. Because of a misstatement, if the decision of a user is getting influenced, then that misstatement we are going to call it as material. Able to understand everybody, clear and comfortable. So this is what the meaning of the term material misstatement. And as an auditor, your first objective is to express an opinion whether financial statements are free from material misstatements. Sir, what do you mean by free from material misstatements? Should the financial statement contain a misstatement or should not contain a material misstatement? The financial statements should not contain a material misstatement. Regarding that, you have to verify and express the opinion. So with this, we are done with the objectives of auditor also. So what basically auditor will do is he will try to verify for this two things: whether financial statements are free from material misstatements, whether they are prepared as per applicable financial reporting framework. If he got satisfactory answers for both the questions, yes, the financial statements are free from material misstatements, and yes, they are also prepared as per applicable financial reporting framework. To both the questions, if the auditor got satisfactory answers, he will give positive opinion. Either to one of the question, if he got negative responses, either for first objective he got negative answer, or for the second objective he got negative answer, or for both the questions he got the negative answer, then he is going to give a negative opinion. Understood everybody? Comfortable? So this is what regarding the objectives of audit or the objectives of auditor. So we understood the definition of audit and all the associated terms with it, and also we understood what is the objectives of the audit, and as a part of that discussion we understood various terms like applicable financial reporting framework, various types of framework, misstatement, material misstatement, all these things we have covered. Clear everyone? So now I will try to cover one more last point and we will wind up this chapter, introduction to audit. So one more important fundamental concept which I want you to remember is, what is the meaning of the term auditor? What is the meaning of the term auditor? So we understood what is audit, we understood what are objectives audit. Now let us try to understand the term auditor. So what is the meaning of the term auditor? Generally, a person whoever does the audit, we call him as auditor. Generally, whoever does the audit, that person will be called as auditor. The person whoever is doing that independent examination, we call him as auditor. But now we need to understand this auditor term in a detailed manner. See, take for example, there is an audit firm. There is an audit firm. So take for example, I'm a practicing chartered accountant. I have started my office. So in my office, I will be there, a practicing chartered accountant who is ultimately responsible for all the works which my firm is doing. So when I say I have an office, in my office staff also will be there. In my office, staff also will be there. Sir, which staff will be there in my office? So basically, article assistants will be there. And in the article assistants also two categories will be there. So there will be senior article assistants, there will be junior article assistants. Sir, what is the senior junior? Senior article assistant is a person who has completed 1 year of articleship. Junior article assistant who is still in the first year of articleship, 2 year in case of senior article assistant, there will be 2000 rupees of extra stipend. So like this, in my office there will be senior article assistants also, there will be junior article assistants also. Take for example, there are some two senior article assistants in my office, and there are some three junior article assistants in my office. Sir, who else could be there in my office? So what I have done is, see, these senior article assistants, junior article assistants, these are not permanent employees. These are all temporary employees. You will stay with me till the time your articleship is there. After that, you will leave. I needed some permanent employees also. So what I have done is, I have recruited one person who has completed his BCom. I have recruited a person who has completed his BCom. I have recruited one more person who is a who did not complete the chartered accountancy course in full. He completed CA inter, he did the articleship, but he did not clear the CA final. And that person also, I have recruited him as an employee, full-time employee. So when you recruit these kind of people, generally the designation given to them will be paid assistants. Generally, what designation will be given to them? Paid assistants. So I have recruited two paid assistants also, one BCom qualified person, other one is a semi-qualified chartered accountant. See, this term semi-qualified chartered accountant is something which we have given. There is no legal recognition called semi-qualified chartered accountant, something like that. This is something which we use it in the common parlance. So my firm is expanding. I'm unable to handle all the works on my own. So what I have done is, I have recruited another chartered accountant, and also I have recruited another cost accountant as my employees, not as partners, guys. My business is expanding. I can't manage everything on my own. So I have recruited a chartered accountant, a cost accountant as my employees. So when you recruit qualified professionals as your employees, generally we give them a designation audit manager. Generally we give them a designation audit manager. So this is what my entire office is. These many people are there. So how many staff are there? So I have a being the head of the firm, I'm a practicing chartered accountant, or in case of partnership firm, there will be 2 or 3 partners also. So head of the firm will be there. Then in my office there will be senior article assistants, there will be junior article assistants, there will be paid assistants, there will be even audit managers also. So all these people are there in my office. So now assume that one day a client, some ABC Limited, a client has approached my firm and asked me to do the audit for them. So I am the engagement partner. I am the head of the firm. I'm a practicing chartered accountant. I thought, okay, sir, I gave the acceptance. We will do the audit for you. I gave the acceptance. We will give the audit. We will do the audit for you. I gave the acceptance. So after I have accepted this audit, one fine day I have to go to this client's premises and start doing the audit. No, one fine day I have to go to the client's premises and start doing the audit. So now you tell me, when we have to go and do the audit as a engagement as a head of the firm, will I single-handedly go and complete the audit, or will I take my staff also along with me? I have to start doing the audit. Just accepting will not give you the fees. You have to go and actually conduct the audit also. So when I have to actually go and conduct the audit as the head of the firm, will I single-handedly go and complete the audit, or will I take my team also along with me? I will take my team also along with me. I have so many staff in my office. I am not giving them salary for time pass. I have to use them for my work. So I have to take along with me all my team also for audit. But I will not take all the stuff. Why? Because I will not just have an audit of one entity. I might be having various other works which I have to take care of. So I will not take all my engagement team members. I will decide whoever is free and take only limited number of persons for this particular assignment. Why? Because I will be having multiple assignments. I have to divide all my team on different activities. So what I have done is, I have decided, okay, I will take this one senior article assistant, I will take this two junior article assistants, I will take this paid assistant, I will take this audit manager. So myself practicing chartered accountant, along with one senior article assistant, two junior article assistants, one paid assistant, one audit manager. So totally how many people? 1 2 3 4 5 plus 1, 6. So totally 6 people, including the head of the firm. So we 6 people collectively as a team, we go to the audit of ABC Limited and we will complete the audit. See, generally we call this as audit engagement, we call it. Audit engagement. Sir, what is the meaning of the term engagement? See, this term also we use it very frequently. We 6 people as a team, being a practicing chartered accountant, one senior article assistant, two junior article assistants, one paid assistant, one audit manager. We 6 people as a team, we go and complete the audit engagement of ABC Limited. Sir, what is this engagement? What is the general meaning of the term engagement? I'm asking you, what is the general meaning of the term engagement? You will say, sir, something which happens before marriage. Agreed. Agreed. That is what you know. Agreed. But that is not the only engagement. Agreed, something which happens before marriage is an engagement, but that is not the only engagement. See, the general meaning of the term engagement is a mutual contract in which there are mutual promises. That we call it as engagement. Take for example, if I agree to provide some service, you agree to pay me consideration, there is an engagement. A mutual contract in which there is a mutual promise. See, even the engagement which you know also happens the same thing. Bride will agree to marry the groom, groom will agree to marry the bride. There is a mutual promise, that we call it as engagement. So engagement is a very broad term which includes any contract in which there are mutual promises. That broadly we call it as engagement. Right? Take for example, there is a doctor who agreed to provide the treatment to his patient and the patient who agreed to give the fees to the doctor. There is an engagement between doctor and the patient. That doesn't mean doctor and patient are going to marry. That is one engagement actually. So there is a lawyer who agreed to fight the case for the client and the client agreed to pay the fees to the lawyer. Engagement between lawyer and the client. So auditor agreed to do the audit for the client. The client in turn agreed to pay the fees. There is an engagement between auditor and the client. So we 6 people, we collectively go and complete the audit engagement of the client ABC Limited. So we 6 people will be collectively called as engagement team for conducting audit engagement of ABC Limited. We 6 people will be called as what? Engagement team. We 6 people will be called as what? Engagement team for completing the audit of ABC Limited. So why I am telling you this is, why I explained you about this term engagement team is, whenever I say auditor, auditor doesn't mean one single person. This entire engagement team collectively will be called as auditor. When I say auditor, auditor includes not just one person. Auditor means the entire engagement team. That entire engagement team will be collectively referred as auditor, not just one person. Sir, who will be there in the engagement team, sir? Being a head of the firm, being the person who signs the report. I am the practicing chartered accountant. I will sign the reports. I am the person ultimately responsible. So I will be called as generally engagement partner. I will be called as what? Head of the firm who signs the reports and all. That person will be called as engagement partner. So in my engagement team, engagement partner will be there. Senior article assistants will be there. Junior article assistants will be there. Paid assistants will be there. And even audit managers also will be there. So when we say auditor, we are collectively referring to entire engagement team, not just one or two persons. So that is what the point I want to make here. When we say auditor, auditor means entire engagement team, except in two circumstances. So generally when I say auditor, auditor includes entire engagement team. But in two circumstances, auditor means not entire engagement team, auditor means only engagement partner. Generally when I say auditor, auditor includes entire engagement team, but in two exceptional circumstances, when I refer to the term auditor, I refer only engagement partner, not the entire engagement team. Sir, what are the two circumstances? Very simple. When it comes to acceptance of responsibility, and also when it comes to accountability before regulatory authorities, in these two circumstances, when we say auditor, auditor means only engagement partner, not the entire engagement team. I will give you example. Take for example, somewhere it was mentioned auditor has to sign the financial statements. In some standard, in some law, it was written auditor is required to sign the financial statements. One day a client came to the auditor's office. He told, sir, as per the law, auditor is required to sign the financial statements. You are the article assistant sitting in that office. Your engagement partner is not there. He went out. So now you are telling, okay, auditor is required to sign the financial statements. No, our auditing faculty told auditor means entire engagement team. I am an article assistant. I am also part of engagement team only. Give me the audit report. I will sign the audit report. Is it acceptable? Why? Because this is a matter relating to acceptance of responsibility. By signing, you are taking the responsibility. So since this is a matter relating to acceptance of responsibility, if it was written somewhere, auditor has to take the responsibility, auditor has to sign the financial statements, their auditor doesn't mean entire engagement team, their auditor means only engagement partner. Only the engagement partner shall sign. You cannot sign there. So their auditor means only engagement partner, not entire engagement team. Clear? Second case where auditor means only engagement partner. See, for example, your firm has done some mistake. You did the audit in a wrong way. So that case has been filed. And one day police came to arrest the auditor. So when the police came to arrest the auditor, you are the article assistant sitting there in the office. Your engagement partner is not there. Can the police take this article assistant, keep him in the jail, and keep him in the jeep and take him to the jail? No. Why? Because when it comes to accountability before regulatory authorities, like somewhere it was told auditor will be liable for imprisonment. Their auditor means only engagement partner, not article assistants, not paid assistants, not audit managers, not senior article assistants, etc. Clear? So when it comes to two circumstances, acceptance of responsibility, when somewhere it was told auditor should accept the responsibility, their auditor doesn't mean their auditor doesn't mean entire engagement team. Their auditor means only engagement partner. Similarly, when the matter comes to accountability before regulatory authorities, like auditor shall pay fine, auditor shall face imprisonment. So in these circumstances, auditor doesn't mean entire engagement team. Auditor means only engagement partner. Clear? In rest all other circumstances, whenever we are using the term auditor, it includes reference to entire engagement team. But in these two circumstances, one is acceptance of responsibility, other one is accountability before regulatory authorities. In these two circumstances, auditor means only engagement team, not the entire, auditor means only engagement partner, not the entire engagement team. Able to understand, everybody? So this is very, very important. So in these two circumstances, I am writing it here also once again. So in these two circumstances, auditor means only engagement partner. In rest of all the circumstances, auditor means entire engagement team. Collectively refers to entire engagement team. Clear? So this is what the discussion relating to the term auditor. So, and as a part of this explanation, whatever we had till now, we have completely understood, or we have completed understanding the chapter introduction to the auditing. So this chapter is very, very important. This chapter is very, very significant. Why? Because in this we got to know all the fundamental things relating to audit. If we are very strong in our fundamentals and basics, the balance concepts also will make sense. So if we are unable to understand these basic terms and basic definitions, no matter how much in-depth discussion we try to do for the subsequent chapters, always something will be lacking. I hope you would have understood this entire chapter introduction to auditing in a detailed and effective manner. So this is what regarding this chapter, guys. Now we will begin with the remaining chapters.